So later I'm going to post that on the YouTube channel. Do you have a YouTube channel? No, you don't have a YouTube channel? Okay, create one, it's free, and you can post your favorite videos on YouTube channel. Yeah, sure, you can post that. Yeah, so you're dancing in your dorm, something you can post it. Yeah. Okay, so the question is this one is 316 is that you use the table to calculate the minimum premium an insurance company should charge for a 5 million 3-year term life insurance contract. So this is actually is a good practice. We learn how to do that calculation and how the insurance company charge you life insurance premium. And this is going to apply to a man age 60, so 6 years old. Assume that premium is paid at the beginning of each year. Yes.
Where is the,
Question?
I guess the Excel spreadsheet?
Excel spreadsheet for this one?
Oh,
Oh, okay. So I'm going to give you that. Okay, so we can, and let me do that. Okay, I posted how about the okay, I create an announcement. Okay, the life insurance. So I'm going to add this file. Okay, that is the documents. If you wanted to know what exactly that question talking about, is I can select the whole thing here.
So the recording for this is going to be on your YouTube channel?
Yeah, it's going to be after that I'm gonna post that in the YouTube channel.
Okay.
Okay, so that's the you can download that file. It goes to the announcement area, so life insurance. Okay, so every year the IRS is going to post the mortality, is called mortality rate. So that's going to update, right? That's going to update. So you can look at this comparing to the one we have in the textbook. Okay, I give you this link. Is the government, they have actuarial life table. So some students, they study finance, and later on they find, okay, their interest is doing like insurance. And the good thing you can do is you can work on or change a little bit your major as actuarial. Okay, actuarial is paid pretty good and very a good future when you do also working in the finance field. Okay, that is going to give you the table is called our period life table, is for the Social Security, and also you can check that for the different year. Okay. And this one is the, you know, this classified into male and female. You can look for that table different years. So they have a long list of you know, various years, you know, you can see. Okay, so and basically the first column is the death probability. Okay, so death probability. So that's the one we're gonna use. And then the exactly that age depends on, you know, how old are you. They calculate the different life insurance premium. Let's say, you know, this is 60. We can follow that using the same age is in the chapter 3, question 16. The age 60 and 61, 62, we're using that 3 years. And what is the possibility people died for a male in 3 years? Okay, so currently, and our man is in age 60, and he wanted to buy 5 million insurance, life insurance. Okay, what is the premium he's supposed to pay? Okay, so that calculation is actuarial, you know, it's like a Excel spreadsheet calculation. So I'm going to show you how to do that. Okay, so basically that table is the most recent update. So we use the table from 3.1. I told you that's old one. Okay, it's not accurate number, but we just using that as a sample, so you know. Okay, so you basically the death of the probability of death is going, that number need to change. Is that okay? So this is the you can see I copied the probability, the death probability for a man age 60, and next the 5 years or, you know, 3 years, that's the probability, the death probability. You can see this is the for female. Okay, and the female is the death probability is much lower than male, right? So last time I talk about men typically die earlier. Okay, so we create a table. Let's see. Okay, we're gonna do that table, and let's see. We look at this table. I'll zoom that, and we make it bigger. Customer land 865%. Okay, so we have the probability of death and for a male. Okay, for a man. Okay, so this is the data we got from the textbook and this is the probability of death within 1 year. This is the original data we got, and then you can see this 60 and 61, 62, 3 years. Okay, so the probability of death for a man age 60 in that year, the first year, is exactly the same, okay, as the first one, right? Okay, the number you got the first year, what is the probability the people age 60 going to die next year? Do you know how to calculate the probability for next year? Okay, so this is you have to survive for the first year in order to live next year, right? So next year die, the following year, the first year is survived. So the survive, that means you have to 1 minus, right? 1 minus 0.01, 1046, and then you times the probability gonna die for the second year. 1835, is that right? So that's how you calculate the probability of death for a man age 60 in the second year. Okay, we need to do that, because you wanted to calculate the principal, the premium for the next 3 years. Okay, look at the formula is 1 minus B3 and times B4, right? Okay, what about the person is age 60 is going to die in the third year? So die in the third year, you have to survive for the last 2 years, right? Yeah. So it's the same thing, you have to 1 minus the first year probability, and then 1 minus the second year probability. Okay, so you have to be this one times 1. Okay, 1 minus that's the second year, and then you times the third year probability. 12728. Okay. So we calculate the probability of death for a man age 60. So that's year 1, year 2, year 3. Okay, now we assume that you're gonna buy life insurance. The principal is 5 million. The current interest rate. Okay, this risk-free rate is 6%. Okay, you can change that to, let's see, we wanted to change it to percent. Okay, we do that. Okay, we wanted to interest rate is 6%. Okay, so now we assume that, okay, the person, if the person died, is died in the middle of the year. In the middle of the year, okay, this is an assumption. It died in the middle. In the middle of the year. Okay, so you can see, and the first year die is 0.5. Okay, we do that. The second year is 1.5, and the third year is 2.5. So we create that the benefit. Okay, if he died at the in the first year, right? In the first year, in the middle of the first year, okay, it's considered to be the cash value. The cash value, do you know how to calculate the cash value he got? Use that, the probability, okay, this one, times the principal. Is that okay? Okay, is your expected value? The first one? Okay, the time is 0.5. Okay, this is 0.5. That's your time. And the expected cash flow, the cash flow is the probability of that 60 years old man die in the first year. Okay, that probability you have is 0.011. 6, and then you times that $5 million US. So if he died in the first year, in the middle of the first year, and he will get benefit, which is that principal times the probability, right? Okay, so do that for the second year. The second year is that you also do the probability. Okay, the second year probability is this one. Okay, second year probability. And then you times the principal. You look at that, the second year probability of death for a man age 60 is accumulate, right? So the higher than the expected value is going to be higher than the first year. And then you got the expected flow for the third year. The third year is that probability here times the principal. Is that okay? Okay. The expected cash flow is in all those are in different time frame. Is a 1.5, 2.5. Okay, this is the cash flow you're gonna receive half a year later. This is cash flow you're gonna receive 1.5 years later, and this is 2.5 years later. So in order to compare the premium you're gonna pay currently, so you have to do what you have to do. You need to calculate the present value of the cash flow, is that right? Okay, so you wanted to calculate the present value of the future cash flow. So the present value, remember how to do the present value?
Equals PV.
Mm-hmm. Yeah, so as the present value is going to be the current value, the expected cash flow. You can see here is that B11, that's the current the cash flow divided by half a year, right? Half a year, and then interest rate. Okay, is that number? This is the cash flow 1. And this is the cash flow 1 you just got, and it could be a CF1 divided by 1 plus, right? This is the half a year. Half a year, it have to do 0.5. And then you times the interest rate. Interest rate is annual rate is 6%, right? And then you remember you have to times 2, right? You're gonna 2 times that half a year. Okay, 2t. And the t is half a year, 0.5. Okay, or you use a capital letter t. Okay, so that is the time period is based on that 0.5. And then you move on to the next. You look at the formula here. Is also 0.5 times the interest rate. Okay. And now you have to raise to the power of 1.5. Okay, because that's a 1.5 years. So that's how you get the present value. Is that okay? So if you you have a question, you can basically you can do is that you can draw our timeline. Remember, we do time value for money. Yeah, you can draw our timeline. Okay, this is the current. And this is the, let's see. Okay, this is a half a year. Okay, this is a 0.5. And this is a 1.5, and this is a 2.5. Okay, this is actually this is the year 1, year 2, and 3. Okay, so what is your present value of the future capital is the capital 1 here. You discount to present, right? This one you discount to the present. And then that's capital 2, you receive a 1.5 years. And then you discount the second one. And then you discount the 2.5. Okay, this is the 1, 2, 3. Okay, so you calculate this is a 1, this is a 2, and this is a 3. So you discount all those. And so later on, you have to sum them up. Okay, you sum them up. That's the total. That's the total present value. Okay, do the same thing for present value of expected cash inflow for $1 of premium. Okay, for the insurance company, they receive $1, and what will be the insurance company's expected $1 cash flow? Okay, so you can see the time they received at the beginning of the year. So you pay insurance at the beginning of the year. It's not going to be like you already die and then you're starting to pay insurance, right? So it's going to be has to pay in advance. So that's why the time you choose is a 0. 1 is the beginning of the second year, and 2 is the beginning of the third year. Okay. Is that okay? And then the cash flow you have, okay, you receive $1. What about the second year? So you're gonna use that $1 minus the first year, that is the probability of death. Okay. This is the 1 minus that 0.011646. That's you got the cash flow you're gonna receive for next year, because there are people they buy insurance at the beginning of the first year. They could die at the beginning of the second year, right? The second year, the probability, you need to remove that probability, because around like 0.011% of people, they died in the first year. So you can only have 0.988956 ounce. And then you do that for the beginning of the third year. So is the cash flow you're going to receive is reducing, right? Okay, so also you do that, do the present value. We assume that interest rate is 6% and do the future value of the cash flow, and that's going to be the same raised to the power of that 2. Okay, t. And the first one you can see is 0, but you still have to raise to the power of 0, right? Raise to the power of 0. What about the present value of the second? Okay, it's also raised to the power of the 1, right? The 30 year, right? Okay, so any questions? And then you sum up that present value. Okay, so now you need to calculate is the ratio, okay? And what is your premium? So the premium is going to be the present value of that expected benefit divided by the present value of expected cash flow inflow. Okay, so it's the number of the total sum of your benefit. This is the total sum of your premium. And so your insurance premiums you're supposed to pay is 57,427. Okay, is that good? Any questions? No, no questions. Are good? Okay, so I'm going to stop sharing and